owner's generally like an S corps, because S corps, they're kind of treated like an employee of the company, and they're supposed to, by law, run payroll on themselves as an owner. So
Right.
they're into this concept, just like an employee. And a lot of the times, your accountant, again, will give a figure of what they want as payroll, because one, you have to have reasonable compensation. That means that, you know, if I hire an employee at $20 an hour and I only pay myself $10 an hour, that's not reasonable. I have to pay myself like reasonable compensation, meaning if I'm gonna have, my average wage is $20 an hour, I gotta pay myself somewhere around 20 an hour.
At least.
Yeah, yes, we're just, and then also because they get to see the end result, they know what your tax liability is at the end, they have a figure of what they wanna see ran through payroll and how much taxes, again, you're gonna have. So at the end of the year, the idea is that you're running payroll throughout the year, and at the end of the year, you're hoping is that you don't owe anything. That's the idea of it, so.
The benefit I found in a business that I run also that helped with having the payroll set up this way through QuickBooks, you know, with the owner on the payroll, was that it also allowed us to set up not just Social Security and tax withholding, but it also allowed us to set up 401k distributions and things like that. And it kind of it has a template where you can just plug the numbers in already, and it made it easier to manage those contributions as we went along, rather than just giant chunks at the end of the year.
Yes.
So,
And what I've seen people do too is they will take draws, if they need draws, and then they'll do a zero paycheck. So they're grossing it up, taking the taxes out, and then they'll just net it against their draw. So it's going in and out of their draw. Do you know what I'm saying?
So if someone took $100 out of business, they'll run it through payroll to bring their net check down to zero, but they're putting it back against that distribution to bring their distribution down to zero.
So you could actually run payroll once a quarter even or whatever to get the tax thing, or once a month, but you need to take money every week. So you're taking whole dollars every week, 100 a week, 500 a week, whatever. Then when you run your payroll, you calculate it backwards almost, so that you're
Back in.
yeah, you're back into it.
I'm hearing lots of good thoughts. My accountant tells me that it doesn't matter if I pay myself via distributions, but my business advisor says I should be paying myself payroll so it hits the P&L. Is there a preference? Is it an LLC? Is it, I'm hearing all kinds of different ideas.
What kind of LLC are you? I
So,
mean,
sole
proprietor.
member LLC?
Okay. Like you said, there's benefits, like you can either do estimated tax payments like they do and they're just guessing, putting it in there. Or I think payroll sometimes can be more beneficial because you're paying it as you go, and you know, like, this is where you want to use your accountant because that's what they're paid for. If they're saying, okay, this is what, I'm going to get into terms here. Okay, so let's say, I'll take an example of me. Let's just say hypothetically last year I paid $5,000 in federal withholding tax, and I paid $2,000 in state withholding tax. The next year I've got to come up with, like, to be safe with the government, is around $5,000 again in federal withholding tax and $2,000 again in state withholding tax. So what I like is the CPA to tell me what's going on, or the accountant is saying, okay, I need you to run through payroll, so at the end of the year we're going to divide this $5,000 out by 12 months, so that at the end of the year we're just going to assume that you're going to make what you did last year, you know, and by the end of the year I've paid in my taxes. I'm not having to guess necessarily, and I like payroll method over estimated tax payment. Let's just say that it's. I like the detail. That's me. I like the detail. I like to know where my money's going versus just having to throw it in and going, okay, I don't really know what's going on. What am I paying towards? So.
I think a lot of sole proprietors and that get more in trouble with the estimated because they're not setting money aside, or if they do have the money setting aside to pay their estimated taxes, then if it's a slower month or something, a lot of people will take that out, and at the end of the year you still have that money as opposed to the payroll that you're paying in a little bit at a time. And I've seen a lot of companies where the owners have went under because they did not pay their taxes on what they took, that, you know, for their estimated.
Which is true. So for example, like us, when we first started, we were an LLC, and I went to our accountant and said, I don't know what's going on, how much are we really supposed to set aside, because I'm taking, so much money out of the business every month. And he said, well, okay, if you're taking this much, then I want you to put 30% away, just so you're safe. So it's putting 30% away and then paying out those taxes. And because I didn't know if the business would, if I had more or if I had less. And so I kind of had to plan on the worst case. And I didn't, like she said, is that the draws are not hitting your P&L. It's not an expense to the business. And I wanted to take advantage of those things. And so at a certain point, we switched from, we were an LLC, but we took on the S-Corp part of it, became a corporation underneath that. And I liked that because I took the tax advantages and the payroll advantages of reducing my net profit in my business, so I'm taxed less at the end of the year. And that was a safer option for me.
Yeah, could you maybe go into like S corp, sole proprietorship,
Okay, with the state, you can be a sole proprietor, you can be an LLC, you can be a corporation. Now, an LLC is a little unique because underneath an LLC, you can be a sole proprietor, you can be a partnership, you can be an S corp. So that status is with the federal government. With the state, they only see you as an LLC. But with the federal government, like she was talking about the SS, you wanted to be elected? The 1120S, you wanted to become an S corp. So that's a federal form, and now they're seeing you as a corporation, not necessarily as an LLC, because they don't identify LLCs.
And how does that lower your end of the year net income?
So what happens with S corps is that they're required to do payroll on the owners. You're required to have payroll. And so what it does is on your P&L, basic, you have your income and you have your expenses. So income minus expenses equals your net profit. With my company, at the end of the year, my net profit. And as the net profit, us as owners have to split that net profit and take it home. So now we're reporting this net profit that I don't have necessarily in my pocket. It's not money I own, possess, but I'm now paying taxes on the net profit when it goes to my personal side. And so for me, the advantage was, if I was taking out 50 grand a year in pay to me, I'd rather have 50 grand in gross to reduce that net profit. See what I'm saying? So my bottom line has the less taxation, and then the company takes on a portion of the taxes because they're taking on the Medicare and the Social Security as well. And they're paying state unemployment for me because I wanted to be in with state unemployment. I don't know why, but I don't ever plan on being employed, but I'm federal unemployment, and they pay those kinds of taxes for me. So I'm only subject to half of the taxation, my federal withholding and my state withholding. So the company starts expensing some of that stuff, which you want to know some of the expenses that you can have, is that reduces your profit at the end. And what I end up having to report to me personally, because that's the scary business, is when I get to see the profit and I'm like, great year, but crap, I owe the government more money. So, does that kind of answer it?
Yeah, I think next week we'll answer more on how it shows up. I don't really quite understand why it's not an expense.
Yeah.
If you take a draw, why it's different, but I'm sure next week that'll look a little bit out.
They're just treated differently. The draw is your equity, it goes on your balance sheet.
They're gonna tax you one way or the other, so if you draw it out, you just wait and pay it at the end. If you run it,
But it'll be less, right? You're saying it'll be less if I,
Let's just say there's not like loopholes. Everybody thinks there's like some loophole. That's the question I get. It's like, how can I avoid it? And like, you're not. You're going to pay it over here, you're going to pay it over there. But to me, I like to pay it in my business because it's a write-off and it reduces my net profit. It's not hitting me personally. I get to divide it out with the other owners, not just me. So it's a better write-off for me.
The draws that are taken, should we just start thinking 30% of any time we take a draw and put that away? Because we're not
Safe
getting a
place.
straight answer about our quarterly taxes, so we want to start putting something away right now. So it's based on what the draws that we're taking out to pay the personal expenses.
Yeah, and a lot of people will do is open up a separate bank account and they'll just call it like their estimated tax payments or whatever. Because a lot of people do is they get short on cash and they start spending everything that they think they're going to save. But if you set it aside, you kind of forget about it.
That's the plan.
So it's a good thing to do. I do that with a lot of clients that have issues around payroll taxes to avoid, we'll get into a lot of the payroll taxes, but to avoid, because what happens is you paid all these employees, you're subject to all these taxes in the business, but then in 15 to 30 days, you're gonna owe out this tax, but people aren't thinking, oh, 15 to 30 days, I'm gonna have to pay it. And so a lot of my clients will calculate what their taxes will owe in 30 days, 60 days, 90 days, a year even, and they'll set it aside, so they won't touch it and use it for everyday transactions. So then they're always safe. They're like, okay, it's just sitting over there, and I'll never have the government coming after me because I'll pay them when it's due.
And what's kind of nice about payroll too is you see it up front, so you have an idea of what the whole, you're not just paying your guy $500, you're paying him $500 plus the taxes, you know, so you have an idea of what payroll is costing, not just the net pay. Okay.
I have a question. So, do you have to pay, do you have to do unemployment insurance if you're an employee? Like, let's say I were to get myself on payroll. Do I have to do unemployment insurance if it's just myself?
No, you can elect the, if you're just the owner,
Yeah.
you can left out.
Oh, you can? Yeah. Oh, sweet. I didn't know you could.
We made a little change to this sheet here, these due dates and deadlines. Apologize about that. When you get set up and you're paying taxes, they will set you up with different kinds of due dates and deadlines. So depending on your volume, you would be a semi-weekly payer, meaning that if you paid payroll on a certain day for 941 taxes, you have 3 business days to pay those taxes before the penalties kick in. That's kind of high volume. A lot of our clients are smaller, they fall into the monthly payers. So they will pay payroll, and then their 941 taxes due the 15th of the following month. And that's kind of what Christine was saying, is 15 days doesn't seem like a lot, but if you're not thinking I have to have that cash, you can get into trouble.
So again, just to reiterate on the 941, what that means is that it's a federal withholding you're paying out the employees, because that's employees' tax. You're paying the employee and the employer's Medicare, and you're paying the Social Security for the employee as well as the employer, which will show you an example of how that's calculated.
And now you get penalized, like if you don't have it in today, because it's electronically, because now they hold it another day, right, instead of when you can make the deposits.
You have till the 15th if you're a
Right.
monthly depositor. If you make the payment today, it doesn't hit till Monday, which is fine, because the 15th lands on a weekend. You have that rule that if it's on a weekend, it falls to the following business day.
So I paid mine this morning before I went electronically, so it credited on the 15th, but you have to now do it the day before.
Right, if you get on the website on the
Yeah.
15th, they're,
You're late, right,
Right.
and you get penalized. I just wanted to,
then there's quarterly report due dates. This 941 report that Christine was talking about is the combination of your federal withheld, your Medicare and Social Security taxes, and then you have a state unemployment quarterly report that's due. Those are due on the last day of the month following the quarter end. And then you would have some annual report due dates, W-2s to the employees, W-2s to the Social Security Administration in the state, and a 940 federal unemployment annual report. Again, that's just a cheat sheet with some deadlines for you.